ComCap Learn brings you the tools and knowledge to cultivate local investments and local businesses. Tap into a nationwide network of leaders in the community capital movement dedicated to moving our money away from Wall Street and into our local neighborhoods. Brought to you by Hatch Innovation and the National Coalition for Community Capital, NC3. Let's dig in.
This podcast is part of the collection called An Introduction to Local Investing. General overviews to many of the topics that get you started thinking about these subjects. This session is a broad overview and introduction to just community capital. What does it mean? Why are we doing it? Why is it important? And we get to hear from someone who really is the person who knows this particular subject intimately. Okay, so Michael Shuman, we are here to talk about community capital, and I'm delighted you've agreed to join us in these ComCap Learn podcasts. You are the leader, the icon, the godfather, the spiritual guide in this world. And you've been doing this for how long?
Well, I've been doing local economy work for almost 25 years, but the local investment piece of it specifically for more like around 10 years.
So tell us why.
As I've been working with local economies and in organizing local businesses, the theme that comes up over and over again is that the most challenging obstacle they face to succeeding is access to capital. And as I focused more and more on that question, I realized that there were many, many dimensions to the problem that were not obvious. I mean, the sort of superficial judgment that people have is, small businesses, if they're good enough, they will find the capital they need, and if they're not good enough, they're not. And that answer never satisfied me, because that answer did not take into account the ways in which the current system is rigged against small entrepreneurs getting capital. And so fixing those problems in the system, I think, is essential to supporting small business and enjoying the benefits that come from small businesses once they're adequately funded.
Nice. So community capital is a set of words we've been using. Talk a little bit about that term, if it seems to be representing what you're up to. How does community enter into this notion of capital?
Well, I think community capital is a good term because capital itself is best understood not just as financial capital, although most of our discussion today will be about financial capital, but it's also about other forms of assets that people have. Maybe there's a history of bartering relationships, as you have in Native communities. Maybe it's natural capital or cultural capital or human capital. And all of these types of capital are very important for thinking about how to grow an economy. And if we're thinking more broadly about local investment and how to grow community capital, so yes, part of what we're trying to do is get the money that people are putting into businesses expecting a rate of return. That's kind of the capital element of it. But there are also things that they can do with their behavior and their own personal money, the way in which they invest in themselves, that may also generate a community rate of return. So, for example, an individual's decision to reduce one's credit card debt is actually going to generate a rate of return for that individual and generates a return for the community because the whole credit card system lies outside the community. And if you're paying 30% interest to Visa or Master International that is thousands of miles away, that's a net loss to your community. So changing that behavior actually is a way of bringing capital back into your community.
Yeah. Okay. Well, so it's different than we're not just talking about cash. We're talking about whole communities thinking about what they do with their assets.
That's right.
Yeah.
And it just turns out that historically, as people think about their investment behavior, the first things that they think about are stocks and bonds, or putting their money into large, sort of faceless banks. And all of those behaviors are going to guarantee that their money fast disappears for the community, and the community will then suffer as a result.
So you've said, and I am pretty sure this is true, that nearly every dime in our communities goes into Wall Street. This idea of keeping capital in the community, as well as supporting small business, is this just a big idea? Is it a small idea? People that are listening to ComCap Learn and this pod class are somewhat experienced. They're probably advocates or interested at one level or another. What else will make them care? What is the deep point or the big picture here?
Well, I think there's a number of levels to this. So the first level is that if you want to have a place that you really want to continue to live in, that place requires a viable, sustainable, just economy. And the best way of achieving that is through a healthy universe of locally owned businesses. We know from a bunch of recent studies done, for example, by groups of Harvard economists, that communities with a high density of locally owned businesses have the highest per capita job growth rate. And we know from studies from the Federal Reserve in Atlanta that communities with a high density of locally owned business have the highest per capita income growth rate. So in other words, if you're interested in bringing down poverty and raising the financial well-being of everyone in your community, a healthy universe of local businesses is the best way of doing so. And we also know that that universe of locally owned businesses does a bunch of other things. It attracts tourists, it brings a bunch of environmental benefits, it helps to promote local food systems, which brings down levels of type 2 diabetes and obesity. It promotes political participation. It promotes social equality. It promotes charitable giving. So lots of things that we want to see in our community, we know empirically are associated with a density of healthy, locally owned business. So that if the goal is to nurture locally owned business, then we're interested next in looking at all the ways that we can support those businesses. And those ways include entrepreneurship support. It includes building networks of local business that are more competitive as a team than they would be operating on their own. It involves local purchasing activity that increases the probability of businesses not just surviving but thriving. It means looking at the public policy environment and making sure there are not tilts in the public policy playing field against local business. But foremost, in my view, it involves looking at capital, because capital is the difference between a successful small business being a flash in the pan and it really growing to be a major employer in a community. And the options that are available for many small businesses right now, many locally owned businesses, are far too few. And we know this because looking at the big picture of the United States, when you look at people's long-term savings, so by long-term savings, I mean the $30 trillion that Americans have in stocks, bonds, mutual funds, pension funds, and insurance funds. If that long-term investment was efficient, if our capital markets were working, then half of that money would go into the half of the economy that is locally owned businesses. And we know that half the economy is locally owned businesses in terms of jobs and in terms of their output. And in fact, almost none of that money does. So that is what economists would call a capital market failure. And fixing that failure is essential if we want to realize all of the benefits we just talked about of a healthy local economy.
Nice. I like the words a just economy. This is not something you hear about. You hear about a market economy, a capitalist economy, a growing economy, a fast economy. But I like this idea of a just economy. Can you address the distinction in capital raising as well as access to capital between startup and growth capital?
Right. So there is one of the mistakes that people make when they're thinking about local investments is, most local businesses are small and small businesses have a high failure rate and therefore they are very risky to invest in. And it turns out that what I just said is fundamentally wrong. It is not true that local small businesses have a high failure rate. It's true that local small startups have a high failure rate. So it is essential for an investor, a would-be local investor, to draw that distinction. And if you are a risk-averse investor, like most of us are, you want to be looking for local businesses that have been around 5 or 10 years, that maybe have 5, 10, 20 employees. They have goods and services that you're familiar with and have been well tested. And they have a reputation for a high quality business that you're investing in. So I think one way of understanding the difference between investing in a startup and investing in a growth company is that a growth company has a track record.
Yeah. Okay, well, how do you get to growth companies if you don't support startup? How do we support startup, I think, in our communities where if capital that is coming from the community and our neighbors and people who live in the community that we're potentially starting this company, how do we both mediate risk, or does investing in a startup that's in your neighborhood mediate risk, I think is one way of putting it. Does community capital have the potential to support startups in a new way, in a different way?
Yeah, I think that community capital definitely can support both startups and more mature local businesses. And the tools involved are a little bit different. So for example, the things that I would regard as the kinds of tools that ought to be of interest to a startup entrepreneur is, how do you build up personal networks of an individual, friends, family, maybe it's an ethnic group? How do you link smaller financial institutions, small banks, small credit unions with that individual? How do we link micro enterprise funds or perhaps dedicated economic development funds to support that individual? We're talking about finance that's probably in the range of $5 to $25, maybe $50,000. So all of these things are kind of in the universe of what we do already. And I think, the key thing is that we want to try to wean entrepreneurs away from getting that money off of credit cards where they're going to be paying 30+% interest to other forms of borrowing that are more in the range of 5, 10, 15%. That would be a real step forward. The next level up, say 50 to a couple of $100,000, that is where you might start turning to community offerings or direct public offerings. We can talk about, the details of those. Or it might be where they go to a more advanced investment fund that is looking at more mature businesses. Or it just may be, you may structure yourself as a co-op because that's a way of assembling capital with a lot of people. So there's a lot of different strategies that you can go for at those higher levels, but it's going to be fundamentally different than that startup. In the startup phase, you're proving concept. You're proving that your business can work. And once you prove that, then you can take it to that next level of getting more money.
Yeah. All right. And I think the crowdfunding model in terms of, sort of co-op 2.0, where if everyone has a bit of risk, but it's nothing that will destroy their savings account and they're willing to support those new ideas, that's also a way to, I think, create innovation and promote startups that might not otherwise get off the ground.
Yeah.
We talked about community capital, and a term that we like a lot is compatible capital. And one of the things that we've discussed many times in the past is this sense that when you go to a bank, for example, and you need $65,000, and the bank says, well, we'll give you 40. And you say, great, I'll take it. You're actually undercapitalized. This is a loan that you're going to take, you're going to use it, but it's really not compatible with your needs. It's incompatible. And at the strategy level, when you're a small business owner or an entrepreneur, you're trying to move forward and appropriately plan. I contend that many of the companies that fail, it's because they're inappropriately capitalized, not always just undercapitalized, but sometimes the terms are also incompatible. This sense of compatibility with communities and compatibility with investors and with the business itself. Can you talk about that as how that's potentially investing 2.0, a way of looking at investing?
Yeah, I think that you definitely need a strategy for mixing and matching different streams of capital in a way that's going to work. I would not go so far as you just laid out to say that if you needed 65,000 and the bank was giving you 45,000, that was necessarily incompatible. Because if it gives you, a few more months to go after the other 20,000 from other sources, that's a strategy. You just have to be clear that you have the ability, the plausible ability within a few months to get that additional 20,000. We're not used to having entrepreneurs think creatively about mixing and matching different sources of capital. They tend to think, this is not my business, and I want to just get one quick hit, one quick fix, and then from that, I can start just paying attention again to my business itself. And what we have to, I think, teach more and more local entrepreneurs is that capital raising actually is an ongoing part of your business. And even when you're swimmingly successful, it's going to be an ongoing part of your business.
I agree. I think that surprise in the work we do when we work with entrepreneurs, they do think of this as an add-on, especially if in the early stages. And if they've self-funded and suddenly they do have to go out to look for money, it's a shock to realize that this is something that they need to do, and it could be full-time. So now, guess what? You've started a company and you have a new full-time job. So yeah, I think sometimes it's a bit of a shock. In terms of investing 2.0, the word invest, as you look at local investing, how do you help people understand that a lot of what they look at when they look at local investing is is what I would say mythology, perhaps, or misunderstanding. They tend to look at things through the lens of what they've seen on TV or, heard on the radio. How do you help people understand the difference, or how do you help people talk about the difference when you're talking about local investing? How do you shape that conversation so people don't go down the path of, well, what's my exit? Or I hear you're supposed to get 5x. Well, that happened to me.
Right. I think this requires patient education of people, and it doesn't come easily or quickly. But we have to educate people that there are many returns from their investment that they should be thinking about. So yes, there is the financial bottom line return, but there is also the return to your community. And if you are investing in a locally owned business, there is a double return. So in other words, that, say, local department store, local mercantile that you've just financed, pays taxes that support your police and support your schools, and that's going to be an additional benefit to you that you would not get if you invested in a company in Malaysia. And then there are additional benefits that you maybe are going to realize from all of this. Maybe, some of your friends or your family are involved in that mercantile store. Maybe it improves your quality of life going shopping there. Maybe that mercantile has some environmental policies that are particularly good for the ecosystem there, and again, you enjoy some of those benefits. So there are multiple rates of return that a local investor gets that a non-local investor will never get. And so we have to teach people to be mindful of those and think about those. Now, that's not to say that a local business does not or should not be expected to get a financial rate of return. To the contrary, my expectation is that over time, locally owned businesses will have a higher rate of return than non-local businesses. And the reason is that at the end of the day, the rate of return that we see from different businesses is a function of their profit rates. And we know that smaller businesses have higher rates of net revenue per dollar of receipt than do larger businesses, which can translate, if appropriately managed, into higher profit rates. We have data from Canada, for example, the most recent statistics on Canadian business that show that the most profitable Canadian businesses have 10 to 20 employees. And those businesses are something like 60% more profitable than the firms traded on the Toronto Stock Exchange. So these kinds of statistics, I think, need to be shared with people, and that can help to inform their investment decisions.
Nice. It is a compelling argument. It's many compelling arguments. And as something that, as sweeping the country, if we're at 31 states and counting, that this is, would you say this is the most transformative approach for our economy in the U.S.? And how do you see this shifting around the world?
Well, I'll tell you that personally, this has been the most transformative cause that I've been ever affiliated with in my, nearly 40 years of adult work. I've spent a good deal of my adult life affiliated with losing causes, and this one feels like one that it's winning, and it's winning in so many ways that I never anticipated. So yes, I think that the capital turns out to be the root of many positive things, and it's the root of many evils. It is the root of the collapse of the global economy in 2008. It is the root of the revival of many local communities that have begun to figure out ways of recirculating capital. So getting this set of decisions right and shaping policies and personal and business behavior around local flows of capital. I think this is really a critical way to reshaping our world in a healthier way.
Oh, brilliant. I wish I could tell you that the people listening were all willing to share some of this weight that has been on your personal shoulders for these many years. But I think to close out, we'd like to thank you, Michael Shuman, again, for all of your many years of work and brilliance and persistence. So we'll close with that, and you will be able to find some of the resources that we've discussed here in the show notes, and we'll look forward to talking to you again. Thank you, Michael.
My pleasure.
I love listening to Michael Shuman, the way this just rolls off his tongue, his history, his experience around the world. I hope you've enjoyed this and it gave you some food for thought. Conversations like how are politics involved in your local economy? How is short-term thinking compared to long-term planning having an impact on your success? So give some thought to these. Contact us at comcap.us. We'll keep the conversation going there online, and take a look at the show notes for additional resources. And we'll look forward to having you on the next podcast, where Michael talks a little bit more about economic development and big game hunting versus growing our own.
ComCap Learn is produced by Amy Pearl, Colin Gabriel, Simon Love, Finn Turdahl, and Danielle Olson out of the Hatch Community Innovation Lab in Portland, Oregon. You can find out more about our platform and conferences for community capital at comcap.us.
She liked it, oh my Lord, you do.